Welcome guys, in this video I will be discussing about business objectives and profits, and I will go through what they are, define them, and then see how we can measure them. So let's jump into the video. So why should we set business objectives? Businesses set objectives to provide clear goals and direction. Objectives help define a company's purpose, guide decision making, measure progress, and align efforts across the organization. So it essentially helps the whole business, everybody involved, to understand what they are working for, have a common aim or goal. They serve as a roadmap for success and enable effective resource allocation, fostering overall growth and competitiveness. Objectives provide a clarity of goals, so they provide a clear definition of what a business aims to achieve. They help give a general sense of direction, so they guide the organization in a specific and purposeful direction, and help with decision making. So objectives assist in decision making by aligning choices with the goals. Moving on, we have progress measurement. Establishing objectives enables tracking, measuring the progress over time. Alignment. Objectives align efforts across the organization, ensuring everyone works towards a common goal. Resource allocation helps allocate resources effectively to support goal attainment. So why should we set business objectives? Well, they give motivation and focus, and provide this to the employees, which helps them keep focus on key priorities. And they also encourage competitiveness. Setting objectives contributes to the overall growth and competitiveness of the business, as employees will compare each other to these objectives. Measurement and importance of profit. So here we go over some key terms for the word profit. So starting off, we have net income, which is calculated by subtracting the total expenses from the total revenue. Gross profit margin, which represents the percentage of revenue retained after direct costs. Operating profit deducts the operating expenses from gross profit, indicating a core business profitability. And net profit margin expresses net income as a percentage of total revenue. Moving further, we have financial health, because profitability is a key indicator of a company's financial health and sustainability. Investor attraction attracts investors by demonstrating a lucrative return on investment. Reinvestment profits provide funds for business expansion, innovation, and future investments. Employee motivation. Profit sharing in business bonuses can motivate employees, fostering productivity. And risk mitigation. Act as a buffer against economic uncertainties and unexpected expenses. So why is profit so important? Well, profit gives a competitive edge to your business or any business, because profitable businesses can invest in quality, technology, and customer service, gaining a competitive edge. It can also help sustainability, because it ensures the long-term viability and success of the business in the market. What is revenue? This is the total income generated from the sale of goods or services. So it's the starting point in the profit equation. Well, costs are pretty straightforward. They are essentially the expenses. But there's different types of costs that we need to know. Business costs are the expenses incurred by a business to produce and sell its products or services. So this can be interpreted as just standard cost. Fixed costs are costs that remain constant, regardless of the level of production or sales, such as rent and salaries. So this cost remains the same, regardless of how much you actually make. Variable costs are costs that vary in direct proportion to the level of production or sales, such as raw materials or hourly wages. So if you if you increase in profits, if you get more money, you might have to increase wages. Total costs is the sum of fixed and variable costs. Now we will find out how we can calculate the different types of profit and what equations we need. So let's get started with the standard profit. So in order to calculate the profit, you need to do the revenue minus the total costs. In order to calculate the gross profit, you need to do the revenue minus the cost of goods sold. In order to work out the operating profit, you need to do gross profit minus the operating expenses. And then in order to work out the net profit, you need to do the operating profit minus taxes and interest. Now we will see the different relationships between profit, cost, and revenue. So profit maximization. Businesses aim to maximize the profit by optimizing the balance between revenue and costs. Cost control. Effective management of fixed and variable costs is crucial for enhancing profitability. The break-even point. The level of sales at which total revenue equals total costs, resulting in zero profit. Economies of scale. As production increases, per unit costs may decrease, potentially boosting overall profit margins. Risk management. Understanding the relationships helps businesses assess financial risks and make informed decisions for sustainable profitability. Why are profits important? Well, they give the business a competitive edge because profitable businesses can invest in quality technology and customer service, gaining a competitive edge in the market. And they also help with risk mitigation. Profits act as a buffer against economic uncertainties, providing a financial cushion for unexpected expenses or downturns in the market.